Dear friends and investors, welcome to Alchemy's monthly market views and video where we discuss aspects relating to the economy, markets, and the investment environment. Last month, if you remember, we spoke about valuations, how market concentration has changed, and how leadership among sectors have changed post the pandemic environment. And as you all know that the markets have recovered very smartly from the lows of March. And one of the things that every economist, policymaker, or investors are tracking is how is our economy bouncing back or recovering. We at Alchemy also do that by creating a in-house activity index of about 13 high frequency indicators. Basically what we've done is that we've taken 13 data points, things like auto sales, cement dispatches, exports, job applications, and so on and so forth, which we call as leading indicators. Typically, these leading indicators will tell you what is the direction and the speed in which the economy is moving. And if we look at that leading indicators for the month of August, what we find is that there is a steady improvement in the economy. We are neither hitting the brakes nor are we accelerating at a very high speed. All data points in August are pointing to a minus 14% year-on-year recovery versus a minus 18% that we saw in July. So there has been about a 4 percentage point recovery between July and August. There are certain early data points that have also come for September, and they have been quite good, with the manufacturing PMI surging to an 8-year high of 56.8 in September versus 52 in August, and exports growing by 5.3% year on year. And this is the first positive growth after 6 months. And we've also seen strong passenger vehicle and two-wheeler sales. However, we need to see whether some of this progress that we are seeing in the manufacturing index, in the auto sales, etc., is a build-up to inventory for the festive season. And what would be important for us to see is whether this demand sustains post the Diwali and the festive season is over and done with. In addition to the activity indicators, we will also talk about the aspect of the interest waiver case which has been going on in Supreme Court. We talked about it the last time that there has been a petition which has been filed in the Supreme Court which is urging the banks to waive off interest on interest during the moratorium period. As you know that this, if implemented, could be harmful to the profitability and stability of the financial system. And the Supreme Court had asked the government to file its reply in the Supreme Court on what their stand was. And finally, the government did last week file its reply in the Supreme Court, where they said that the government was in favor of waiving the interest on interest component, but only up to a loan amount of 2 crores for retail and MSME customers. For the rest of the customers, there would be no waiver. Now, this we believe is a very positive development for the financial system and the lenders as a whole, and it removes one of the large overhangs that this case had in the recovery of the financial sector. In our estimate, the total loss as a result of the waiver of interest on interest up to that 2 crore permissible limit could be anywhere in the region of 5 to 10,000 crores, which constitutes just about 1% of the capital of the banks, and therefore is not very significant even if the government does not step in to compensate the banks and NBFCs for the loss of that interest. Well, friends, it is said that India reforms only during a crisis, and that is definitely true because the government enacted two very, very significant structural reforms post the COVID crisis. One was the Farm Bill. There were three important farm bills which were passed in the Rajya Sabha. The bill permits interstate and intrastate trade of farmers' produce beyond the physical limits of what is called as the APMC markets. What used to happen traditionally is that when farmers produce their agricultural produce, they would go to the mandi or the APMC market and they had to sell their produce at the market itself. They were not allowed to directly deal with the private sector or with the buyers or with companies. Now, the farm bill that has been passed does away with those restrictions and many other restrictions that were imposed on the farmers, including stock limits and so on and so forth. In our belief, this is almost like a 1991 reform moment for the agriculture sector. And it is very significant because we believe that as and when this gets enacted, and we will see that there is increased private sector participation in the agri sector. You will see food processing companies, you will see large food and grocery chains now directly dealing with farmers and buying produce from them. And it is estimated that the farmers could earn anywhere between 4 to 8% higher prices than what they would get, because there would be abolition of middlemen and taxes in between. We believe this should unleash significant productivity gains in the farm sector, bring enhanced investments, and largely develop logistics and the infrastructure that we so desperately need in our agriculture sector. Believe you me, this may not lead to any significant one-to-one correlation or gains in the stock market or by buying into agri-based companies, but this is definitely a big structural positive, and the impact of that, in my opinion, will be seen over several years as we develop our farm sector to move up the value chain. The second most important reform, which the governments were always criticized of not bringing to the table, is the labor reforms. And again, the lower house of parliament passed three major bills pertaining to labor. The biggest benefit of these bills would be to improve the ease of doing business in India through reduction in compliance for companies. Out of 44 labor laws, many got repealed and many got subsumed into just 4 codes. 2,300 sections have now been reduced to 460 sections, and nearly 1,000 compliances have been reduced to 250. These reforms, my friend, are also likely to lead to a greater formalization of our economy and improve the employability of a large workforce, and the demographic dividend that we talk about will not get wasted. This is a very important supply side reform, and I believe that the labor reform, in conjunction with the corporate tax cut that the government did in September 2019, and with many other such administrative reforms, should make India a very attractive destination for foreign direct investments. And therefore, I think that in especially with context to the Indian economy, I believe that the COVID crisis has not gone wasted, and the government has moved ahead on these two very important structural reforms, which is the Farm Bill and the change in the labor codes. There is one more very important reform that we had spoken about last time, which is divestment. Let's hope that we get to see some action on that front in the next few months. Friends, now that we've spoken about the reforms and some of the macro happenings in the economy like the activity tracker, let's talk about one very interesting aspect for which I have got many queries and questions in the past few months, and that is, what is your view on small and mid caps? Is this the right time to invest in small and mid caps? And this question has arisen because, as we had mentioned last month, that in August, the breadth of the market rally was very, very impressive, which means that there were many more companies and sectors which did well on the stock market as compared to the experience in 2018 and 19, where just a handful of few large caps moved the index. And probably 2019 was the most concentrated rally that we saw in the markets in a long, long time. But that has changed since July and August this year, as we started to see that mid and small caps also started to participate significantly in the market recovery and rally. And therefore today we will spend a little bit of time studying whether it makes sense to invest in small and mid caps and what our view is. So we will talk about a few data points and trends that we've seen over the last 15 to 20 years, because that's a good enough time frame for us to come at some significant conclusions. If you look at the slide in front of you, you will see that there have been phases in the market where the small and mid caps have outperformed the large caps, and then there are other times when the large caps tend to do significantly better than small and mid caps. And if you look at the periods of outperformance of the small and mid caps, for example, between 2004 and 2006, there was an 18-month period where the small and mid caps outperformed the large caps. Then again between 07 and 08, and then we know that between 2014 well up until January 2018. But if you break up these periods, one of the interesting aspects or data points is that the duration of this outperformance of the small and mid caps typically ranges between 10 months to 18 months. On the other hand, if you look at the outperformance of the large cap versus the small and mid caps, you will see that the dominance of large cap outperformance over mid caps, which have happened, let's say, between just after the crisis in 08-09, or between 2011 and 2014, and then more recently, as you all know, between January-February 2018 up until September 20. You will see that one of the important characteristics is that the large caps tend to outperform the mid caps. The average time period has lasted from 18 months to almost 40 months. So if we look at the recent phenomena in the markets, right, if we go back, the last significant underperformance of the small and mid caps was actually during August-September 2013, just before Modi won the first election, right? And if you remember, and we've written about this many times in the past, that there was a significant undervaluation in August-September 2013 when there was a macro crisis, and the small mid cap index was trading at somewhere between 650 to 750 basis points below the valuation of Nifty. And we saw a massive rally from there, from the lows of August-September 2013 till the election results in May 2014. There was this euphoric period in anticipation of a Modi victory. Then after that long rally, we had a sideways consolidation phase between November 14 and November 15 for a year. And then we again saw a massive pickup in the rally in the small and mid caps and the broader market between February 2016, which lasted up until November-December 2017. And since early 18, as you see, we've seen a sharp underperformance of the small and mid caps. Now the difference was that at the peak in Jan-Feb 2018, the small and mid cap index was trading at a substantial premium to large caps, and therefore a correction was overdue. And if you remember, friends, what brought in that correction was essentially, that was the budget in which the long-term capital gains was brought in. And then there were also several regulatory changes that we will look at. If you look at the slide number 5 in front of you, we've plotted the rolling 1-year return difference between small, mid and large caps. And as you can see that it is a very, very cyclical phenomena, right? So this constant under and outperformance is a market phenomena, and we should be ready to understand this, that this is a thing which is very, very cyclical. There is no structural outperformance of small and mid caps to the large caps. Every couple of months there are cycles where they underperform and then they again begin to outperform. The other most important thing that we need to keep in mind, that while we all like to invest in small and mid cap companies which we think can become very, very big, but the other characteristic is that we have to be ready to see substantial drawdowns or corrections in the small and mid caps. If you look at it by and large, you will see that the mid and small caps tend to correct anywhere between 1.5 to 3x of what the large caps can do. And that's a pretty deep drawdown. For example, if you take the December 17 to February 19 time period, you will see where I mentioned that the markets were very, very polarized. The Nifty was up 2%, the mid cap index was down 21%, and the small cap index was down 41%. And mind you, I'm not talking about one stock. You can imagine that a stock corrects by 40%. Here I'm talking about the small cap 100 index correcting by as much as 40%. During the 2007-8 crisis, the small cap index was down 74%, the mid cap index was down 64%, while the Nifty was down 50%. And during the current COVID correction, the Nifty was down 37%, the mid cap index was down 40%, and the small cap index was down 45%. So if you are an investor in only small and mid caps, you have to be ready for very significant drawdowns. The next characteristic, which again is very, very important, is that the strike rate, which means that how many stocks can move from their lower category to the next category. So if you are a mini cap stock, can you move to a mid cap? And if you're a mid cap stock, can you move to a mega cap, right? And you will observe that during every time frame, the success rate is extremely low. So if you take, let's say, a time period of 2002 to 2005, right? Out of a 1039 micro cap companies, right? Only 58 companies moved into the mid cap category, and only one company out of 1039 companies could move into the mega cap category. Similarly, if you take a recent time frame of, let's say, between 2010 and 2015, out of 1841 companies, right, 64 companies only could make it to the mid caps, and only 3 companies out of 1841 companies became mega caps. But those 3 companies gave an average annualized return of 68%. and those 64 companies which became mid caps gave an annualized return of 38%. So it tells you two things. One, that the success rate or the strike rate is extremely low. But if you get it right, then your compounded returns can be very, very staggering. But therefore, it is not very easy to assume that just by buying a basket of small and mid cap stocks, you will end up making phenomenal returns over a long period of time. Stock picking becomes extremely important, and the strike rate, believe you me, despite your best intentions, is extremely low. Moving ahead, these are just examples of companies, which may be perfectly high quality companies, but you see even a stock like Page Industries, for example, moved from the lows of 10 and 12,000 to almost 35,000 in 2019, and then back to levels of between 15 to 20,000. And this has happened to countless small and mid cap companies. Another thing that is important is to understand the role of regulations. As we all know that in Jan-Feb 2018, when the mid caps first started to correct, yes, there was overvaluation, but the trigger which started the correction was the SEBI regulation on the ASM framework, the fact that there was again a definition change between what constitutes large cap, mid cap and small cap. And I remember at that time, a lot of the funds had to indiscriminately reduce their exposure to small and mid caps, and that started the bear market in small and mid cap stocks. So sometimes regulations also play a very, very important role. Now the complete reverse has happened in the current year. We saw a massive underperformance of the small and mid caps during the COVID fall, and after a 2-year period, they started to trade at a discount to large caps. But now we had a reverse trigger. We had the SEBI regulation for multi-cap funds, where they decided that at least a 25% of the portfolio should be in mid caps and 25% should be in small caps. And hence, since then, we've seen a significant rally in small and mid caps. Well, that may not be the only reason why small and mid caps go up, but it definitely acted as a trigger, just like regulations acted as a trigger for a bear market in small and mid caps. So therefore, if we stand today here, where are we in the cycle with respect to small and mid caps? Now, it is very important that a couple of conditions are satisfied for a sustainable run or outperformance of small and mid caps. Currently, in my opinion, 3 out of 5 factors are positive for a mid and small cap rally. One is that there is enough liquidity in the markets. B, we are seeing the birth of new sectors emerge: specialty chemicals, electronic manufacturing, even agri has now has a lot of legs to run because of the kind of great monsoons we've seen and the reforms on the farm side, and very low relative institutional ownership. If you take FII plus DI ownership, you will see that the ownership is at reasonable lows at this point in time. As far as valuations are concerned, I think we were at a discount during the fall in March. We are now at a slight premium to large caps, but these are still early days. And secondly, it is very important, typically small and mid caps tend to do well when the economy is accelerating. So while we saw a deceleration, if you see, in fact, it fits in very well that the economy was consistently decelerating between January 2018, even pre-COVID, and then obviously there was a sharp contraction in the economy because of the COVID crisis. But now we are beginning to see that the economy is beginning to recover. So while the economy is recovering, we have massive liquidity in the markets, we are seeing a birth of some new sectors, and we are seeing low institutional ownership in the small and mid cap space. The regulations are turning in favor of small and mid caps, and the small mid cap valuations are also coming off their lows. These are just some of the charts that you can see which talked about these 4 or 5 factors. After a gap of 2 years, we are now beginning to see that the small caps are trying to catch up with the large caps as well. And during this rally, you will see that the small cap and the mid cap performance has been almost equal. We talked about the liquidity and the global and local central banks, how they've poured liquidity into the system, how interest rates are low, and that forms a reasonably good basis for or conditions for a rally in small and mid caps. And we are beginning to see the acceleration in the economy. As I spoke to you, if you look at the activity indicator from the absolute lows that the economy saw in March and April and May, we are beginning to see a sharp revival from June, July, and a steady performance in August. Hopefully, we will continue to monitor how the economy continues to recover. And we are seeing the birth of new sectors. So let's say between when the small and mid caps rallied in 04 to 08, it was the infrastructure sector. A lot of construction companies, EPC companies did phenomenally well. Then post the global financial crisis, again when we had a rally, it was companies from agrochemicals and logistics which did well. And then from 2014 onwards, we saw the birth of specialty chemicals, staffing companies, niche services. And now, in my opinion, post the COVID crisis, while we continue to see some of the older sectors like specialty chemicals, pharma, etc. continue to do well, I think some of the new sectors could be platform and internet plays, and also import substitution or China plus one manufacturing beneficiaries. We talked about the ownership. As you can see in March 14, the ownership of the NSE mid cap was only 9%. If you take the ownership of FII plus DII, from 9% it went to a peak of 12% in early 2018, and now it has fallen back to 9%. So I think there is under ownership institutionally, and therefore that is also one of the important factors. Now the question therefore is that how should I, if we believe that 3 or 4 out of the 5 factors are favorable for a small and mid cap rally, and we may continue to see the breadth of the market improve as the economy improves and the market improves, I think the best way to play this is through every multi-cap strategy. Why? Because we get the best of both worlds. One is that there is safety of capital and compounding that comes with large caps. As I showed you that the average length of large caps outperforming mid caps is anywhere between 18 to 40 months, while the outperformance of the small and mid caps is for a much shorter period of time. Secondly, higher returns and alpha generation can be used more like it's like a topping on your ice cream rather than the ice cream, right? And good portfolio characteristics for a good multi-cap strategy could be reasonable concentration, focus on quality, strong growth, and a good mix of sectoral leaders and challengers. And therefore, if you see Alchemy's all PMS strategies are designed as multi-cap strategies. So with this, friends, I end this month's video. I hope that all that we spoke about today and discussed was useful to you. I wish you and your family members the best of health, and we will continue to be in touch. Thank you so much.